Warren Buffett, the Oracle of Omaha, is a name synonymous with investing success. His wisdom stems from a lifetime dedicated to understanding markets and businesses. Buffett's investment philosophy, centered on value investing, has consistently generated impressive returns. This essay explores one aspect of Buffett's approach, his perspective on cash. Is it a relic of the past, or does it still hold relevance in today's dynamic financial landscape? Buffett's insights are particularly relevant because they challenge conventional thinking. In a world often fixated on rapid gains and short-term profits, he stands as a beacon of patience and long-term vision. Understanding Buffett's stance on cash offers valuable lessons for both seasoned investors and those just starting their financial journeys. Buffett's investment philosophy is often likened to building a house. Just as a sturdy structure requires a strong foundation, successful investing, according to Buffett, demands a bedrock of fundamental principles. Central to this foundation is the concept of value investing. Buffett seeks out undervalued companies with strong fundamentals and the potential for long-term growth. He believes in thoroughly understanding a business before investing, likening it to buying the entire company. This meticulous approach minimizes risk and positions him for sustained success. Buffett's philosophy emphasizes patience and discipline over market timing or speculation. He famously said, "The stock market is a device for transferring money from the impatient to the patient." This philosophy, with its emphasis on intrinsic value and a long-term perspective, forms the basis for understanding his views on cash. Let's hear from Warren Buffett himself on his views about cash. Cash is always a bad investment. When people said cash is king a long time ago, they were wrong. Cash is going to become worth less over time. Cash, in Buffett's world, is more than just a medium of exchange. He views it as a strategic asset, a tool for capital preservation and opportunistic investing. This perspective stems from his belief that market conditions are inherently unpredictable. Just as a captain prepares for storms, Buffett maintains a substantial cash reserve to weather economic downturns and capitalize on market dips. This dry powder allows him to purchase undervalued assets when others are fearful. Buffett's cash position is not about timidity, but about preparedness and strategic flexibility. "We just want to have lots of liquidity," Buffett once said. "We want to be like the python that can lie in the sun for a year after a big meal." This approach aligns with his long-term vision, ensuring he has the resources to act decisively when opportunities arise, even during periods of market turmoil. History speaks. Buffett's cash cushion. Buffett's track record is replete with examples of his cash strategy in action. During the 2008 financial crisis, while others panicked, Berkshire Hathaway, Buffett's company, was flush with cash. This allowed him to make strategic investments in companies like Goldman Sachs and General Electric, deals that yielded substantial returns. These moves underscore the importance he places on maintaining a Fort Knox of cash. Buffett's approach is a stark contrast to those who chase short-term gains. He once quipped, "We try to be fearful when others are greedy, and to be greedy only when others are fearful." This contrarian approach, fueled by a healthy cash reserve, has been instrumental in his ability to outperform the market consistently. A changing landscape: cash versus digital. In today's digital age, the concept of cash is being challenged by the rise of electronic payments and cryptocurrencies. The ease and speed of digital transactions are undeniable, leading some to proclaim the death of cash. However, Buffett's perspective, rooted in prudence and long-term thinking, offers a counterpoint to this narrative. While acknowledging the convenience of digital, Buffett remains cautious. He has expressed skepticism about cryptocurrencies, famously comparing them to rat poison squared. His reservations stem from their lack of intrinsic value and their potential for speculation. Buffett's approach suggests that while digital payment systems are transforming how we transact, they don't necessarily negate the fundamental role of cash as a store of value and a strategic asset, especially during times of uncertainty. The verdict: is cash truly outdated? So, is cash truly obsolete in today's economy? Buffett's perspective suggests that the answer is more nuanced than a simple yes or no. While digital payment systems offer undeniable convenience, the core principles underlying Buffett's cash strategy remain relevant. Prudence, preparedness for uncertainty, and a long-term perspective never go out of style. Cash, in Buffett's view, is not merely about outdated payment methods. It represents financial flexibility, a strategic asset that allows him to seize opportunities and weather storms. In an increasingly complex and interconnected financial world, these principles remain as relevant as ever, reminding us that sometimes the most traditional assets hold enduring value. What is your view? Please comment below and subscribe to our channel. Navigate wealth with Svoboda Finance.